Hi guys, hope you guys are good. Today we have a new jam. So I want to make a pattern recognition series where I'll be posting five different asset class on 5 different days in a specific time frame where we trade the 7-Eleven model. So this pattern repeats every day. It doesn't matter what asset class you trade, it just repeats over and over. I'm just gonna make you see how it works. So first of all, before wasting any time, just hit the subscribe button so we can be able to make live lessons, live executions, so we can be able to get more deep dive on the ICT concept because that's what we're trading on a 7-Eleven model. Let's build the ICT community. Let's be able to work together in growing the community. Yeah, so let's just get into it. Just hit the subscribe button. So first of all, I just want to explain the 7-Eleven model. As you can see here, the time is 7 here and it's 11 here. The main purpose of 7-Eleven is that you can find opportunities on in trading between this time frame between 7 and 11. There's a plethora of opportunities that you can find that you can work on and trade as much as you want. So first of all, I just want to um, explain my 7-Eleven model. So from here, the time is 7, the price created relative highs and relative lows. That's basically what you need to do and find between this time frame. Then the price traded higher to take out the buy side liquidity, which is the 7 a.m. highs here. It went to the 1 minute balance pre-cap block. As you can see, we have a high, low, and a higher high. So this becomes the most important point of interest. Then the price traded to it. I actually traded this concept from 7 to 11. I traded this run here and this run here. I'm just gonna pop up the picture at the end of this video. Just stick around to see that. So the price created a displacement lower, taking out the sell side liquidity, creating a market structure shift, and retrace back to the fair value gap that it left open. So here, to confirm that this fair value gap was valid, I was using the New York True Open, which is the 730 candle. Yeah, the simple rules of a true open is that you buy on a fair value gap above the true open. So in this case, we have this fair value gap here. Then I took a sell from this fair value gap. When I'm bearish, I'm taking a sell above that fair value gap, and when I'm bullish, I'm taking a buy below the fair value gap. So now I've took this sell from here to this fair value gap here, which is a 1 minute fair value gap, and to confirm that the price is was gonna get to this area here, what I did, I just measured using my this is 6 a.m. candle. I measured using my fib extension. This is a 6 a.m. candle, and we have a 30 minutes of New York AM session opening. So this 30 minutes interval gives you how far the price is willing to go for the 7-Eleven model. So I use this every single time when I trade the model to see how far the price is going to go and how far the distribution is going to move. So I'm just gonna take my fib from here. This is 6 a.m. New York time. Then this is, see where is 630. 630 is around here. So the lowest low between 6 and 630 is here. I click on this low and then I drag it back to this high here. So by doing this, now I have a measurement of this second standard deviation where price is confirmed that it's gonna go to this level here. The Fibonacci standard deviation, they're not measuring, they're not the reversal of the trend, but they are the measurement on how far the price is willing to go. In other words, what you need to do is only to find the PD array that's below those lows there. As you can see, we have this fair value gap here. So it was a point of interest for me. So I'm going to get back to this point here because I just want to outline something when it comes to this side. So now I figured the second standard deviation is here. I've marked it. Now I know where the price is likely to go around when it manipulates on the 7-Eleven. So now that we're looking for a buy side, remember the low and the high. So from this to low to this high, and I drag it back. Now I found the second standard deviation for buy side. So we have it here. This is a second standard deviation measurement on how far the price is willing to go when we deliver the price. So before the price does all of this, I already marked out these levels here. So it's easy for you guys to find the actual delivery if you can know your measurements and how to use them, how to use the Fibonacci, how to use the retracements and all of that. So if you can just subscribe so we can make our videos, our live stream, I'm going to be able to share all of those details with you. So now that the price has got to this point, when it retraces back to this fair value gap here that's above the true open, I take my measurement, I measure from this high to this low here, to this low here. So now we see, now I have the second confirmation that the price is going to go to this area here. So these confirmations, they're the one that give me a confluence on how far the price is willing to go and how far the price is willing to deliver. So this is a second standard deviation, which is the target of this drop down that came here. So I took the sell here and take out the my profits here. So I would have bought this price from here to that high, but the only thing that make me to doubt that this was going to be going up is because we have this fair value gap here, and also we have this low here and this low here. If I could just mark them, let me mark them. Here's this relative lows here. As you can see, this side, the price didn't take out this outside liquidity that I've marked. So now that the price didn't take out that liquidity, it gave me a doubt that the price was going to go higher, because was looking for price to take out these relative highs and then trade to this consequence encouragement, the 50% of this fair value gap. Then I was going to take a buy from there. So I've missed this opportunity to take a buy here. But what did I do? I just waited for price to get to the true open, which is right here. This is the New York True Open. The price traded higher, then it consolidated. As you can see, it created these highs and created these lows. And then the price at a specific time, the price traded to this low here. As you traded this low, you traded to the 1 minute fair value gap that's here. You might ask yourself, why didn't I choose this fair value gap or other one? I'm choosing this one because this one is where it's closer to the New York True Open. So I'm gonna make a lesson to explain more about the True Open, but I always use them for executions and exits. So I took a buy from here up to this high here. How did I know this high was confirmed? Because of, remember, we've measured the 6 a.m. to 6:30 high. This was the second standard deviation here. And another confirmation, it was that this high, it was last week Friday's high. It was the last week Friday's high. So I always look forward into trading price to the previous Friday high, because those Friday's highs are very important when it comes to delivery of price during the following week. So now that we have this high here, I also measure this deviation from this low here to this high here. I'm using this because there is the swing low that's responsible for taking out the subset liquidity here. So the second standard deviation is here on this line here, the dotted lines. Let me just remove my fib. But as you can see, I took the fib from this low to this high. Then that's my second standard deviation here. So now you can see I had in for manipulation for the 7 a.m. model. I took the standard deviation from here to here, and I also use this deviation from the New York opening range, and I measure to this fair value gap here. So same thing that I did for on this side, I also did it for to this side. Everything repeats accordingly every single time. This thing repeats every day. So you see now that the price got here before 11. This was my actual exit for the day. Once the price retraces lower, I'm no longer interested in the market. So in other times, the price can just get to this high exactly at 11. So that's what basically 7-Eleven model is. So this is an example for Euro USD. This is a pattern recognition series that I'm gonna make. I'm gonna make another videos trying to break this same pattern that repeats every single day, so you guys can see how often you can make profit, how to find consistency in your profit, if you can just adjust to time and adjust to waiting and not be afraid of FOMO. So I hope you find this one insightful. I'm gonna make more videos of this. I'll be starting the mentorship on the 5th of March, I think. So just subscribe to my button. Sorry, just subscribe to my channel, hit the subscribe button so we can be able to be a community. Those live streams, I'm going to be making live executions, I'm going to be giving out lessons, I'm going to making trade run through, so we can analyze the market, the pre-markets, and how to look forward to the next sessions. So yeah, I hope you guys find this insightful. Till we talk to in our next video. Have a blessed one. Thank you.